Hi, this is Nilus Mattive with Money and Markets TV. I specialize in income investments, so I get a ton of tax-related questions on dividend stocks. But the type of investment that generates the most confusion is master limited partnerships, or MLPs. First, I want to explain how MLPs differ from regular corporations. A corporation is a separate legal entity from its employees and investors, and it's treated as such at tax time. So any money it has left over after paying its taxes can be used for a range of purposes, including R&D, acquisitions, or dividends. And when shareholders receive those dividends, they have to pay taxes on them. But master limited partnerships are not considered separate legal entities from their employees or investors. The partners are liable for the obligations of the partnership, but also get the direct benefits. Only certain kinds of companies can qualify for this special status. At least 90% of the company's income has to be from certain sources like interest, real estate rents, gains on commodities, and revenue from activities related to natural resources. This is why you'll find a lot of MLPs that own timberland or oil pipelines. But the important difference between corporations and MLPs becomes clear during tax time. Corporations pay taxes, and then their shareholders who receive income from the corporation pay taxes again. But a partnership's income is treated as if it's earned by all the partners. The partners also share in any other events that typically affect taxable income, such as deductions and credits. By law, MLPs are also required to pay out most of their cash flow to partners in the form of regularly quarterly distributions. These payments may look like plain dividends. However, there's an important difference. Payments from MLPs are considered a return of capital, so they're not taxable investment income. That means that if you're a partner in an MLP, these distributions are tax deferred, just as if they were in a 401k or traditional IRA plan. What happens is that the cost basis of your partnership units, the price you originally paid, gets adjusted up and down for the distributions, income, and pass-through tax items. But there are also two tax disadvantages to holding MLPs. The first one is that any amount of income that exceeds $1,000 will be taxable even if the MLP is held inside a tax-sheltered account. That's because it's considered unrelated business income. And the $1,000 limit is not applied to each individual holding, but rather the income you might be receiving from all your MLPs. For that reason, you don't want to hold MLPs in tax-sheltered accounts like IRAs. Now, if you own just a small position in an MLP or two, this might not make a difference. Plus, you can also find certain MLP funds that will negate the risk of triggering the UBI tax. But the safest route is simply holding your MLPs in taxable accounts. The other disadvantage to holding MLPs is the possibility that you'll have to pay lots of state taxes. The reason is that many MLPs operate across a vast swath of the country. So technically, you could be earning income in many states each year. Realistically, though, even if the individual states were looking at this, you would have to own a substantial portion of units to come in above their income thresholds. But it's something to be aware of. Is it all a bit tricky? Yes. But MLPs do their best to help investors wade through the process. Plus, it's precisely these little hurdles that keep a lot of people away from MLPs, leaving the juicy yields to those who are brave enough to sit down and get their hands a little dirty. Of course, if you're interested in MLPs, you should meet with a tax professional who's familiar with your own circumstances. But I think the additional effort is worth it, considering that some of my favorite MLPs are now yielding 6%, 7%, or even more. I'm Nilus Mattive for Money and Markets TV. Thanks for watching.